Welcome, everyone. Thanks so much for joining us. I'm your host, Caitlin Cormier. At first glance, novice investors might think dividend investing is pretty straightforward. Just buy stocks that pay dividends, collect dividend income while you hold them, and you're done. Well, building a dividend portfolio can be a lot more complicated than that. And there are a few common mistakes that investors tend to make as they learn the ropes. In this webinar, we're going to identify some of those common pitfalls for investors and how they might be able to avoid falling into them. Here with us are Dan Kent and Matt Litalien from Stocktrades.ca, an investor community focused on Canadian stock research. Dan and Matt have over 30 years of combined DIY investing experience. At Stocktrades, they research stocks daily and share insights they uncover. Dan and Matt, great to see you, and thank you for taking the time to chat.
Hi, Caitlin. Nice to be here.
Nice to meet you. Nice to be here too.
Before we get rolling into your list, let's get to know both of you a little bit better. How would you describe yourselves as investors?
I guess I can start being the elder statesman of the two. So as mentioned, my name is Matt. I've been investing since I was 18 years old. So in the late 90s, been through several different, market corrections in terms of the dot-com bubble, the financial crisis, obviously the recent COVID crash. I'm kind of dating myself here in my age, but, started at the age of 18. And, when I started, it was really all about penny stocks and really just throwing money at the wall, see kind of what sticks. But over the course of time, I kind of realized and learned how to do fundamental research. A lot of that had to do with my MBA and, just my university degree in commerce and learning how to do proper fundamental research. From there, I kind of turned into a dividend growth investor over the years, and that's really the foundation of my portfolio with some growth stocks sprinkled in.
Very good. What about you, Dan?
So yeah, my name is Dan Kent. I as well have been investing since I'm 18, 19 years old, but I am a lot younger than Matt. So been doing it now, since 2008, 2009. As an investor, primarily when I started out, I did focus almost solely on dividend stocks, dividend growth stocks. But as I moved forward, got more confident in analyzing companies. I started buying more growth options, kind of seeking out total return over just looking at dividends. And I did that probably 5 or 6 years ago. And now, still the bulk of my portfolio contains dividend paying companies, but I do have some more aggressive growth options mixed in. In the US and Canadian markets, I buy individual US and Canadian equities.
Very good. So both kind of right from the beginning of when you could actually start trading, you were both very interested. So obviously a shared passion. So you have a very interesting origin story as business partners. You've actually never met in person. So how did you come together to build Stocktrades, and how has it been going?
So we started Stocktrades, myself and my business partner, Dylan, we bought it from somebody else in 2014. Didn't really do anything with it for a few years. And then in 2016, we were like, okay, let's make a go at this. And we primarily started it because, we just felt that the Canadian space was lacking in terms of investment research. And at the time, it was pretty much a hobby. We didn't expect it to turn out as large as it has turned out. But Matt and I kind of connected on Facebook. I think Matt could probably confirm this, but it was in like an investing group. I think it might have even been in a dividend investing group. And we were just looking for some writers to kind of help us supplement the content. And I believe Matt had mentioned something about potentially, writing more. So we kind of connected there. And then, after seeing Matt's writing, his knowledge, we kind of decided to partner with him and go on board in creating our Stocktrades Premium service, which is kind of like a subscription-based research platform. So yeah, that's kind of how we connected. We have never met in person. Yeah, Dylan and I are both from Calgary and Matt's from Ontario. So yeah, it's pretty crazy.
Yeah, it's pretty unique in the sense that, and you're right, we did meet in that Canadian Dividend Facebook group that was there, where I was a moderator actually of that particular group. But I was writing for many years for Seeking Alpha, and one of the few actually Canadian writers in that platform and highlighting Canadian stocks. It's, I would say, 99% US based, especially at that time. So, I've also written for a couple of publications like Motley Fool, Tip Ranks, and things like that. Then when Dan kind of reached out and wanted writers for his site, I kind of jumped at opportunity, and we just kind of hit it off, because as we kind of built a relationship, we realized that we had very similar approaches to our investing, very similar styles, and we just really connected in terms of that research. And we decided to kind of deepen the partnership and launch that premium service that Dan was mentioning.
The magic of social media connecting you guys. That's very cool. Like, met through that common passion right on social media. You hear so many bad stories coming from it. It's nice to have a positive like that. So you both personally invest in dividend paying companies as a key piece of your investing strategies. What is it you like so much about dividend stocks in particular?
For me, it's not necessarily that they pay a dividend themselves, but you'll often find probably 90-95% of blue chip companies pay a dividend. So I think it's more just, I'm not necessarily seeking it out for the dividends, although the passive income is nice. It's more so just solid companies for the most part. Ones that have had consistent cash flow for decades will eventually pay it out as a dividend, and especially they'll grow that dividend.
Yeah, and for myself, I have I would say, a lower risk tolerance than someone like Dan, probably just, given our age gap. And to me, the, good, solid paying dividend growth stocks was something that really appealed to me in terms of my risk tolerance. I really like the idea of compounding annual growth and income that kind of builds over time. So that's something that kind of really, really appealed to me. And it's something where, I'm very much a goal-oriented person. So having, a targeted, dividend income that I'm targeting year over year is something that appealed to me and something that was very attractive. So, it was something that just really fit with not only just my risk tolerance, but my style of investing and just me as a person in general.
Okay, so thanks so much for helping us kind of understand your investing mindset. Now let's get into the list of common mistakes that you see dividend investors make. The first mistake is chasing yield. What does that mean?
Right. So this is one of my favorite topics. I think when people think dividend yield, we're talking about the annual dividend divided by the share price, right? So it's the annual dividend you get, and your yield is based on the existing share price. So when I hear the term chasing yield, to me, it means that somebody is looking at the yield as their investment thesis. So they see something at 9% or 8%, something very high outside of the average, and they're looking at and they're buying it because it's a high yield. And the research tends to stop right there. Whereas we know that the yield could be high for a reason. It might be high because there was a dip in share price. That might have happened because they had an event that really impacted the company, that may impact the company in the future, and that may impact their ability to pay that dividend in the future. So I think chasing yield for me is really that at its core, is those that just look at the dividend yield in isolation and make an investment decision based on that.
If you're chasing these yields and not, analyzing the underlying company itself, if the distribution or the dividend does get cut, it's almost guaranteed that the share price is going to crater as well. So, it's follow the underlying company, and then if the yield is attractive, you can continue on from there. That's typically what I would do.
I was just going to add to that. I think that it's important that investors realize a high yield is not necessarily a bad thing either, right? There's many high yields that are sustainable, but they're backed by likely strong growing cash flows, things like that. Most real estate investment trusts have higher yields. Some pipelines do, things like that, but they have an underlying business that warrants that type of yield. So not that all high yields are bad. I just want to make that clear. But you need to take that step further and do your due diligence on the underlying fundamentals of the companies. You can't rely on that yield, which is what chasing yield really means.
Right. So kind of just using it as the sole piece of information as opposed to looking for other factors to back it up, kind of thing, just kind of looking at that yield. So then in that case, what are some of the signs that you look for to suggest that a dividend yield might be unsustainable?
Well, there's several metrics that investors can use to analyze a dividend. I mean, the most common one is against earnings, right? So your dividend payout ratio against earnings, and that's the ratio that you're going to see across many different sites publicly posted. You might see a payout ratio of 60% or something like that. That means that the company is paying out 60% of earnings. Now, that in isolation doesn't really tell you a whole lot. You really have to understand what's a good payout ratio for that industry, for the company, things like that, to kind of actually make an informed decision as to whether or not that payout ratio is sustainable and whether or not it has been going up over the years or down, things like that. My favorite, if you will, are payout ratios against cash flows. Typically free cash flow and operational cash flows, or for pipelines and real estate investment trusts, you have different types of cash flows like distributable cash flow or funds from operations, things like that. But looking at against cash flows, to me, it gives you a better picture of the safety of that dividend.
The free cash flow is, for the most part, the best way to analyze the safety of a dividend for most companies, because you'll see a lot of stuff that comes off the income statement that actually doesn't cost the company any money in that year. So it can really impact the payout ratio in terms of earnings. It can make it seem really skewed. You'll see that with a lot of utility companies, telecom companies, stuff like that. So free cash flow is the best, but then you need to look at it. A company needs to have relatively consistent free cash flow in order to be able to use that payout ratio as well. If cash flow is really volatile, the payout ratio might look good one year where they don't spend much capex, capital expenditures, and then the next year it might look really bad. So just kind of a steady ratio in that regard too.
Right. And the higher the payout ratio, the more at risk that dividend might be. And we saw that in waves during the COVID crash. So a lot of the companies that ended up cutting their dividend over the course of that big COVID crash was because they already had higher payout ratios, and given the current environment, weren't able to sustain that dividend payout, based on their expected earnings for that particular year. So it really kind of that whole crash really put things into perspective. And it was a little bit different than the financial crisis, which was focused on financial companies. Even at that, majority of Canadian financials did quite well through that. But the COVID crash was really different, and it really came to light. And I think a lot of individuals really started to see the importance of looking not only at earnings, but at free cash flow to kind of determine the safety of that dividend.
Okay, so this transitions us pretty nicely to mistake number 2, which is using a dividend payout ratio that might be misleading for a particular industry. So you kind of talked about those different industries and how you have to kind of compare apples to apples, if you will. So what are some examples that often confuse investors?
So financial companies, typically you're looking at earnings is probably the best ratio to look at in terms of the dividend, because majority of financial companies generate negative free cash flow. That's just the nature of the business. So comparing the dividend against cash flows doesn't really make a whole lot of sense. And then we have things like pipelines, if you will. Pipelines, they will actually, for the most part, publish what their payout ratio is against something like distributable cash flow. The problem with sometimes pipelines is it's not GAAP, right? So that means it's not a standard metric across all the businesses. So if you're looking at one pipeline versus another pipeline, the ratios may not be directly comparable. So that's just kind of something to take into account, especially if they're publishing their own ratios. They usually have their own formula that they're kind of developing to create that.
Yeah, I was just going to mention that pipelines are probably like the most confusing companies for investors who are using like earnings as a payout ratio, because most of the time you'll see almost every pipeline here in Canada is paying out more than 100% of their earnings, like for the most part. Sometimes it varies, but it's same with telecoms. A lot of them get confused. They're like, how has this company raised a dividend for 2.5 decades straight? They're paying out 180% of their earnings. So that's why that distributable cash flow is kind of key there. And then another one would be real estate investment trusts, people using net income or earnings per share to kind of figure out how that distribution is paid. And that's not necessarily good either, because with a REIT, a lot of things, depreciation, amortization, the sale of assets, stuff like that can really impact net income. So a lot of those REITs will use funds from operations or adjusted funds from operations, which kind of, takes all that into play. And then you compare that to the distribution. Well, you pretty much have to look in the company's quarterly report. Most all of them will put it in there. But if not, you would have to manually calculate it yourself. A lot of the telecoms during the low rate environment, they spent a ton of money, ton of capex on, expanding infrastructure and stuff. So even these companies sometimes had negative free cash flow. So in that case, sometimes, you can look at operational cash flows to kind of gauge the safety of the dividend, because, stuff like capex can be scaled back. And that's kind of what I was going back to, saying don't let 1 year of, a very good payout ratio or say a very low payout ratio in that regard kind of like skew, what you're looking at. It's more, you should take a long-term average if you're looking in terms of operational or free cash flow, especially on, companies that might not spend so much 1 year, spend a ton of money the next year, stuff like that.
So let's move along to mistake number 3, which is focusing on yield on cost when investing. So this is one that you're particularly passionate about, Dan. So what is yield on cost and why do you choose to disregard it?
So yield on cost is essentially what you're yielding based on the price you paid a long time ago. So say you invested $20, you initially were yielding 10%, $2 a year. 5 years from now, the dividend has doubled, and you now think you invested $20 and you're now yielding 20% because the dividend has doubled to $4. But in reality, this isn't necessarily the case. And a lot of people actually make investment decisions on this. They say, well, I don't want to sell this stock because I'm currently yielding, 20%. I bought it, 5 years ago. I don't want to sell it. I only paid $20 and now it's yielding 20%. But in reality, say in that 5-year period, the stock price doubled as well. You have a $40 stock now that's yielding 4%. That's yielding $4 a share. So the actual money that you have is still yielding, that original 10%. You could sell that stock today and you would get $40. So I just feel that a lot of investors kind of basing it off something they paid, a price they paid 5 years ago, isn't really relevant. It is completely relevant to gauge the dividend growth of a company. A lot of companies that you'll see that will grow the dividend very fast, you can look back at your yield on cost and you will see that you do have a very high yield on cost. But just, in my opinion, looking at something like that, what you paid 5 years ago and compare it to what you're yielding today, it just kind of leads, investors in the wrong direction.
I think that if you're making an investment decision based on yield on cost, you're missing, the bigger picture, and you're potentially missing out on some, excellent companies that are potentially yielding higher than that initial company that you're having. So to Dan's point, when he was mentioning, you can actually have, even though you have 20% yield on cost, you still may only be getting 3% or let's say maybe even 2% yield on that particular investment. And if you were to sell that and buy something that perhaps is a better investment, faster growing with a higher yield, you could be generating greater total return. So I think it's important that the yield on cost is not the focus of the investment thesis. And in my opinion, there's too many that focus on that.
Right. So getting stuck in the past of what you paid for it versus kind of focusing on other things and keeping more current with what's going on with the stock at the current time. So let's roll into the last mistake that we're going to cover, which is ignoring high growth stocks because they offer a lower dividend yield. Why do you see this as problematic?
There seems to be a stigma against low yielding companies amongst your traditional dividend investors, if you will. And in my opinion, investors are missing out. You can have a very solid, low yield, high dividend growth company that is growing at a pretty rapid pace that can yield greater total returns than, a company yielding perhaps something like 5%. So there are a lot of really good companies out there that investors are missing in their portfolios because, once again, you're focused on that yield aspect and you're not focusing on the total returns. Focusing on total returns, in my opinion, is what I prefer to do. You look at a company that yields a low yield but's growing a dividend at 20% per a year, and then share price is growing at 20% because they're growing earnings, at 20-30% annually, that's quite attractive for the portfolio and will yield greater returns than a company that is potentially growing at 1% annually, has a dividend that stagnates, not growing, or might be growing by low single digits.
If you have a share price that stays flat and the dividend is growing, the yield is going to go up. But if you have a share price that is increasing, the yield is going to go down unless dividend growth outpaces that share price growth. So a lot of people look at, particular companies here in Canada that have had low yields for, like a decade, and they kind of think that there's no dividend growth there. Sometimes there's going to be a ton of dividend growth, but there's also going to be a lot of share price appreciation there. Because yield is simply, share price compared to the dividend, if the dividend is growing at a strong pace, if that yield is still staying low, it kind of means that the underlying share price is increasing at an even faster pace, which ultimately, a lot of people kind of get stuck on simply the passive income that they would earn from an investment, and they kind of ignore the underlying appreciation of that stock itself. So that's why they tend to ignore a lot of these, companies that have raised dividend for 10 to 15 straight years, but they still yield, maybe 1.5%. And they just say, oh, I don't want to own that. I want something that's going to make me more money. The underlying share price has been it's helped your return. It's not solely the income.
All right. And if you want to learn more about striking a balance between dividend growth and yield, check out our webinar with Mike Haro from Dividend Stocks Rock about evaluating dividend stocks. You both focus on dividend growth more so than dividend yield in your portfolios. What is the happy medium between growth and yield that you personally look for?
If I have a company that has a lower yield, then I'm going to be looking for higher share price appreciation. So that means I'll be looking for a company that has a higher growth rate. If I have a company that has a sustainable high yield, I may sacrifice some of that growth and accept the lower growth rate. So that's kind of, my approach to dividend growth investing. It's a sliding scale, if you will. For
the most part, the best returning companies in my portfolio since I've started investing are actually the ones that don't really yield that much. They're in that low, 1 to 1.5%. Usually my highest yielding companies, besides a select few, have actually been my worst performers. They've still been fairly strong, but the lower yielding ones, with that fast dividend growth, that means they're growing earnings at a pretty rapid clip as well, which means ultimately, the market values companies typically based on their earnings. So if earnings are growing fast, the share price is going to grow fast, the dividend is going to grow fast. And in terms of yield, I don't really necessarily look at yield at all. And in terms of dividend growth, if I'm looking at a solid dividend growth company, dividend growth above inflation is kind of like a necessity. This is especially important when you look at very mature companies that don't really grow their dividends by, some smaller dividend growth companies are 20-30%. But if you see like a major company, a mature company that's, growing the dividend at 2 or 3%, or even worse, dividend growth has been declining. It's kind of a massive issue because realistically, a lot of people who, they buy a high yielding stock and then the dividend is only growing at a, 2 or 3% pace a year. Your passive income, like you might think you're making more money, but in reality, your purchasing power is going down, especially in this environment when we're seeing 8+% inflation. And I find a lot of people do kind of get caught up with, a stock that yields 8%, but it's only growing the dividend at a, 1 or 2% pace. You're actually losing purchasing power every single year. So the number one thing for me, I would look to growing earnings. Then I would look to growing dividend growth. I would make sure that it's, over and above inflation at the very minimum.
And hopefully we can get inflation back in line, so that'll be a little easier to manage moving
forward.
Exactly.
It's pretty hard right now. Like there's not a lot of mature companies, especially here in Canada, that can keep up with that inflation, especially like the higher yielding, telecoms, utilities. They just can't grow their dividend at a, 8 to 10% pace. So yeah, that needs to calm down a bit as well.
Yeah, and that's a good thing to note as well, is that when you're looking at dividend growth, you want to look at a sustainable dividend growth rate. So you want that dividend growth rate to be matching their earnings or cash flow growth rate. So what happens is if the company is consistently raising a dividend above their earnings growth or above their free cash flow growth, then at some point they're going to get to a situation where, they're not going to be able to raise again because they're, it's outpacing their earnings or free cash flow growth. So I like to see companies that have a sustainable dividend growth approach.
Okay, very interesting. Well, thank you both so much for sharing your perspective. And we're not quite done yet. We're about to transition into our live Q&A shortly. But before we do, I'm going to demonstrate how you can research some of the criteria we've talked about on WebBroker. All right, now we're in WebBroker. We're going to click on Research, under Tools, and click on Screeners. The screeners that we have here, we have some themes as well as some preset screens. This is where we're going to go today, and we're going to scroll down to a couple that might be of interest to dividend investors, namely top dividends, so stocks paying and growing their dividends for shareholders that seek cash income from their investments, as well as undervalued dividend payers, stocks growing dividends ranked by price to earnings ratio for value with a focus on lower debt. We're going to click on that particular screen, the undervalued dividend payers, to actually take a look a little bit further into this screen. So we can see here the criteria that has been used to build this screen, and there's 248 matches out of all the securities on the Canadian US stock exchanges. It ranks the top 10 as well as the rest here. We can see the criteria used: price to earnings ratio, price to book ratio, dividend yield, dividend growth rate 5-year average, debt to equity ratio, stock price, and share type. We can click on the particular company if we want to see more information about why it was listed in the top 10. But what we're going to focus on as well today is looking at some back testing. So I'm just going to go ahead and calculate. What this is doing is calculating a mock portfolio of the top 10 matches and comparing it against a benchmark. In this case, the S&P TSX 60s index. It's doing it on a buy and hold for 3 months method, and we can see the return of the screen versus the S&P 60. So as we see here, the screen has returned over a 5-year period, 36%, versus the S&P TSX has returned 35%. Again, we can change to different time frames, so we could choose 3 years, 1 year, or even shorter. And as we scroll down, we can actually see those individual returns as well as annualized returns. We can change to different indices as well. We just have to simply click and choose a different indice and recalculate. Next, we're going to click on Research, and we're going to click on Stocks. So we're going to get some information specific to one security. So we're going to click on the Fundamentals tab and Peer Comparison. This is giving us the fundamental information for the security that we're under, as well as the industry average and some peer comparison. I'm going to scroll down here specifically to that dividend information, namely annual dividend rate, dividend yield, and payout ratio. It shows us that information for the company that we've searched, the industry average, as well as those peers. So instead of us going out and having to find this information, it puts it all together in one convenient spot to save us some of that time doing that extra research. Finally, we're going to go up to the top here, and we're going to go to charts under this particular security. What we're going to do with charts is we're going to add some specific information about dividends. So I'm going to click Lower Indicators, add Dividend Yield, and I'm going to click on Events and choose Dividends. So what I can see here is those specific dates that dividends were paid, as well as that dividend yield over that 5-year period. This helps me to track the growth in dividend payouts each quarter, which I can use to calculate the dividend growth rate. The dividend growth rate formula is the latest dividend amount divided by prior year dividend amount minus 1, multiplied by 100, which will give us a percentage change. So for example, the latest dividend amount, $1.70, divided by prior year dividend amount, $1.20, minus 1 multiplied by 100 equals 41.66% for dividend growth. You can also track the change in dividend yield over time. Okay, Dan and Matt, let's head into our live Q&A.